The outlook for M&A and IPOs has improved as most believe the rate hiking cycle has come to an end. A declining or even a stable rate environment bodes well for equity prices, and that tends to boost issuance. Also, more predictability in rates should ease some concerns about financing costs from buyers, and that can help bridge the pricing gap and get M&A going. I'm Joe Mantone, an editor with S&P Global Market Intelligence, and on this episode of The Pipeline, I spoke with JMP Securities analyst Devin Ryan about the sentiment for M&A and IPOs. Devin Ryan is currently with JMP Securities, which is part of Citizens Financial. Devin is a longtime analyst, and investment banks have been part of his coverage for years. He's seen many deal cycles and does think the current one is starting to normalize. M&A has been down substantially over the last 2 years after hitting a high point in 2021. Devin expects that 2023 will mark a low point. During our conversation, Devin explains the signs of improvement he's seeing and also mentions some potential catalysts. To start, I asked Devin about the recent earnings calls from large banks and wanted to get Devin's thoughts on what the executives are saying about the deal-making outlook.
Well, I think we've been in a period, Joe, for the last 2 years that it's been pretty extreme and pretty negative. And that's coming off of a record 2021, which was kind of an aberration to the positive. And so I think what we're talking to companies about, hearing from companies on earnings calls, is a normalization process. And a normalization in activity doesn't happen overnight, but I think the process is underway. And so the tone from companies was that they're seeing an improvement in sentiment, and they're seeing both corporates and sponsors engage more in the market. And so the expectation is that 2024 will be a transition year of recovery towards probably a quote unquote more normal 2025. So I'd say overall an optimistic tone, and that's reflected in the market backdrop with equity markets recovering and also interest rates stabilizing. And so sentiment in the corporate community and sponsor community is quite a bit better today than it was, call it 12 months ago.
But was it more optimistic than the previous earnings cycle?
Yeah, I think it's been a progression. So if you could look at the market mood, markets really took off in late October through even where we are today with Russell 3000 as a proxy, trading it effectively its all-time high. That's a round trip from, if you go back to early 2022, where the markets really bottomed or really started to move lower, and then essentially bottomed in September of 2022 and declined about 25%. We've increased 35% from that bottom in the third quarter in 2022, and now we're back to kind of all-time highs. And so as you think about the sentiment, it's only been improving in recent months. And so I would say the tone started to really shift more constructive in the middle of 2023. The third quarter earnings calls, I think the tone was better, and the tone we're hearing thus far in the fourth quarter with equity markets again back to kind of all-time highs is even more constructive.
Advisory-focused investment banks will be reporting earnings soon. What will you be listening for on those calls?
So I think you're going to see similar commentary from those companies around the market backdrop, the improvement that they're hearing from clients, both sponsors and corporates. The fourth quarter tends to have a little bit of positive seasonality for businesses like M&A. So I'm actually expecting a reasonably constructive earnings season. We have actually every company expected to at least be in line or beat modestly. But I think investors are going to be much more focused on the outlook commentary. And as I mentioned, look, is that I think 2023 is likely a trough year for M&A, and 2024 will be a transition year, but a year of improvement. And so that's what I think you're going to hear. That's going to be the tone. M&A is one business. It's the biggest business for these companies. The restructuring business, which is anywhere from, call it 20% of revenues to 40% of revenues, PJT being kind of the most exposed to restructuring. That had a very active 2023 in terms of activity. I think you'll see probably some slowdown in 2024 and probably slowdown in revenue contribution. So our expectation is that in 2024 will be much more about an acceleration in M&A advisory fees and probably a little bit of a slower trend in restructuring fees. And then, there's other businesses like capital markets and shareholder advisory and fund placement. And I think overall, those businesses are expected to perform better in 2024 as well. So the tone into 2024 is quite a bit better. What I would say additional is that, corporates actually were more active than sponsors in 2023. Corporates were roughly flat in terms of their deal volume in 2023 over 2022. Sponsors were down about 40%. So really, the M&A market, the recovery needs to come from sponsors, because corporates, not that they're active, but sponsors are incredibly depressed. They had their worst year in announcements since 2013. And so I think you're going to hear about a recovery in sponsors as well, and that's going to be necessary to drive kind of a broader M&A market recovery. So those are some of the things we're looking for, but that's our expectation that we will hear that. And so, it's been a better story for the stocks, but also for revenues for these companies heading into 2024.
Sure. I know a lot of the larger investment banks have made some announcements about making some cutbacks. Has the advisory focused firms, have they been able to pick up talent during this time?
Yeah, the advisory focused firms have been very actively recruiting over the past couple of years. And actually, I think this past year, some of them had record recruiting years. And that's driven by a couple of factors. It's driven by actually the other side of it is, the talent and the cost of talent has come down some from, the peak levels of, 2021 was this record M&A year. And so compensation was at a record level, but also when you're as active as you are as an M&A banker in 2021, as an example, it's very hard to leave the firm you're at. And so, because the markets have been a little bit quiet over the past 18 months, perversely, that creates an opportunity to potentially pull somebody away from a larger bank that may previously not have been able or didn't feel like they were able to leave. So I wouldn't say the recruiting has been as much about layoffs as it has been about the conditions for recruiting have been more favorable. And then there's just still a lot of white space at really all the independent investment banks. And so it's always competitive. Compensation, as you look at kind of this year, compensation ratios for 2023 are up meaningfully over 2022. Some of that is because revenues are depressed, but some of that is also because companies are optimistic about the next couple of years and want to make sure that they pay competitively to keep their team on the field. And so they are recruiting, but I would actually say less about the layoffs and more about the conditions to recruit being more favorable, but it's still incredibly.
So just to make sure I understand that correctly. So are you saying that the investment bankers don't have deals in the pipeline, so it makes it easier for them to move around because they're not actively working on something?
I think when they are actively working with numerous clients, it's very hard to leave a client in the middle of the transaction and go take another job, go on garden leave. They start a new firm where you're starting at zero and have to reintroduce your clients to that firm and all the connectivity that that firm can bring for your clients. And so when things slow down a little bit, it creates a little bit of a window for people to think about moving. The reality is that the independent investment bank model is that they really need to get the best people in the market for them to be successful. It's really a relationship business and a capability business, but you need to have great people. It's not just about the brand of the organization or, call it the balance sheet. And so, the independent firms are going after A+ or A talent all the time. And so those people are always hard to pull away from, let's say, the large investment banks where they may have been successful before. So every hire is somewhat idiosyncratic, but when the market conditions soften a bit, people potentially are more open to having that conversation and, their clients are a little less active. So it creates a window for them to be able to have the ability to leave and then have a runway to reestablish that relationship.
You mentioned earlier that there's more optimism, and you mentioned a few catalysts, the improvement in the stock prices of the equity markets. I mean, is there one thing that you can point to that's the biggest factor that could lead to the M&A recovery? Is it interest rates?
I think it's all interrelated, Joe. Confidence is very important, and uncertainty, is the biggest challenge to companies moving forward on transactions. And so as the markets start to calm down, valuations, as I mentioned, have kind of round tripped back to roughly their high watermark. That shrinks the bid-ask spread between buyers and sellers. So if you think about, buyers' expectations reset a lot faster than sellers' expectations. Sellers are almost always tethered to their previous high watermark. So when public equity valuations go down by 25%, and private valuations are probably following in a similar ballpark, the seller is still thinking that they're worth what they were worth at the high water mark. And so you have this kind of bid-ask spread that gets quite wide when you have these big shake-up in prices. And so the fact that we've now recovered a lot of that downturn is very important. And then interest rates are both an input and an output of the equation. An output in the sense that, in order to figure out what price you can pay, you need to understand what interest rate you're using, but they're also an input because the valuations are just in the markets are affected by interest rates. Having uncertain interest rates is quite challenging for a buyer to understand what they're going to pay for a business. And so therefore, having some stability on interest rates is important. You don't necessarily have to have huge cuts in interest rates. It's more about the stability and shrinking the uncertainty in the market. And so I think that we've made a lot of progress on that over the past 2 quarters. And so again, the overall tone in the market is much more constructive today than it was as I started here a year ago. And even, they've been improving over the past few months.
So just the expectation of interest rate cuts is enough to sort of help bridge that bid-ask gap.
I think expectations of just more stable interest rates. Cuts are maybe gravy, to reduce the borrowing costs, but just more stability and more certainty. That's what's, I would say, the most important dynamic versus where we've come from, the fastest interest rate increase in 4 decades. And, call it 6 months ago, 9 months ago, an expectation that they may be going even higher. That just creates a lot of uncertainty in that part of the market, but then also there's a trickle down into prices, and equity valuations are quite volatile. And that's kind of the market that we were in 6 months ago, 9 months ago. As I mentioned, there's been a pretty substantial recovery in valuations. Now we've kind of round tripped back to, as of today, essentially back to all-time highs on these public markets.
And you mentioned more activity from financial sponsors, but maybe this year in M&A. I mean, do you also expect financial sponsors to be more active in the IPO market?
Yeah, I think sponsors will be more active, period. Sponsors, you think about their impact on financial markets. They're incredibly engaged in the capital markets from an equity side, but also the M&A side. Sponsors are sitting on $2.5 trillion of dry powder right now. That's obviously a record. And if you look at the relationship of sponsor dry powder, that $2.5 trillion to sponsor announced M&A, in 2023, that relationship was the lowest we've ever tracked. There was only 35% or 34% of announced sponsor M&A to their dry powder. Historically, going back to 2000, that's averaged about 85%. So that gives you that sense of sponsors were very disconnected relative to, call it that important historical relationship of how much dry powder they have. And so you need to see more than 100% increase in sponsor M&A just to get back to something more normal, let alone something that I would say is frothy or extended. So just gives you that sense of how challenging the backdrop has been for sponsors, and the sense that there's this record level of dry powder out there, and sponsors are inevitably going to re-engage in the market because that's really their business model. And so the other part of that, on the equity side, is with valuations recovering, the exit market for prior investments is more attractive. And so they are going to participate on that side as well, in our opinion. So they want to participate on the M&A side and make new investments. And they also want to exit investments. And that's kind of the life cycle, and then ultimately be able to go out and raise that next fund. And that's something that has really been on pause for the past 2 years.
Typically what I've heard when we're in a deal-making recovery cycle, the equity markets come back before the M&A market. Is that what you expect this time around as well?
Yeah, I think they're both coming back kind of in tandem in reality here. Equity issuance may pick up faster just because an equity deal, typically a follow-on deal, can happen really quickly. An M&A transaction could be many months, if not, well over a year in the making, of companies talking and negotiating. And then ultimately, by the time you get to announcement or even get to a completion, that could be better part of a year or even longer. And so equity deals by nature, can occur faster, but that is what we're seeing. I gave some stats on the M&A market. just to be clear, M&A activity, peaked in 2021, 2022, 2023 were down years. Just to get back to a historical trend line in M&A, going back, call it 30 years, M&A activity announcements would need to increase about 40%. Okay, so that gives you the order of magnitude just to get to something that's historically normal. For equity issuance is even more depressed than M&A. If you look at a long-term trend line for equity issuance would need to increase about 80% just to get back to that long-term trend line. So that just gives you the sense of, these last 2 years have been aberrationally slow, not normal, and there's a lot of upside to normal. To me, the next question is, how do you get to normal and how long does that take? Historically, it takes for M&A 1 to 2 years once you've troughed to get back to that baseline, that up 40% from here. And so our view is that Q3 was the trough. 2024, you'll likely see an improvement in M&A volumes of, call it roughly 20% or a little more than that. And then up into 2025, another roughly 20% in 2025. And that will get you to that kind of historical baseline. And that is historically kind of the trend that it takes a couple of years to recover. And equity issuance, to your point, can recover faster, but I think actually it has more room to go.
Why is equity issuance so depressed? I mean, as you mentioned a couple of times, the valuations have been higher. Is it just investors are still being, risk adverse?
I think it's a process, and I think building up those backlogs takes some time, particularly in the IPO market. And I think the trend, if you listen to the earnings calls thus far, is that is happening behind the scenes. The follow-on market, the secondary market, you're already starting to see in early 2024 some positive signs. So healthcare being one of those verticals that is super capital intensive and, is really always going to raise capital. Healthcare is starting to come back. Amount of volumes in its early days here, but just in January are roughly 2x what they were in January of last year for the healthcare sector. So to me, that's kind of a positive indicator. Equity issuance, again, is an area of the market where, there are certain verticals where deals have to happen. There's also a lot of money that was raised. The record year of 2021, creating a little bit of a longer, call it a period for companies to be able to extend their next capital raise or next funding round. But I do think we're getting closer to that period where companies are feeling more pressure to raise money. But then on top of that, because you've seen this really material revaluation and even over the last few months, that's creating a much more constructive backdrop. And I think it's going to be sector by sector. Not all sectors have kind of recovered their high watermark. Technology is an example. There's still pockets of technology that are well below where they were at their peak levels in 2021. But overall, the tone for equity issuance is quite a bit better. And I would expect, again, similar to M&A, 2024 will be a transition year. I don't think we get that up 80% this year, but I do think it could be up 40%.
Something else that's been a headwind for M&A has been the antitrust scrutiny from the current administration in the U.S. Is that something that investment banks are still concerned about at this point?
I think it's something that is absolutely in the conversation and does influence some deals. If you take a step back, there's 40,000 M&A announcements every single year. Okay. So the M&A market globally is very broad and very diverse. And there's probably a couple handful of deals every year that are actually impacted directly by antitrust issues. So those are large deals, could be big fees for the industry, but it's generally a very small number relative to that 40,000 deals every year. And so I do think that antitrust is in the conversation, does influence certain deals that may or may not get announced. That also tends to kind of ebb and flow a little bit with the administration. So that might be a little bit of an election type of issue, depending on who's in the White House next year. Perhaps there could be people that want to wait or people that decide to go based on their views there. But it's a really small number of deals. So even though it is in conversation, it's kind of a secondary factor, in my opinion, to driving M&A versus confidence, valuations, interest rates, and some of the other kind of more relevant driving forces of why M&A gets done or doesn't get done more broadly.
And we did see a couple of really big transactions at the end of 2023, two largest deals of the year. Is that an indication that companies are getting more comfortable?
Yeah, I'm not sure if it's specifically related to antitrust. Every deal has idiosyncratic dynamics. To me, it's more of a theme of M&A markets are improving, and the tone around M&A more broadly is improving, and that kind of progressed through the back half of last year. And our expectation is that you'll probably see more of that activity follow in the first half of this year, and that'll be probably less around antitrust dynamics and more just around where valuations are and confidence. And really the fact the M&A markets have been dead for 2 years, companies need to move on with their strategic plan. So when you have kind of that stability in the markets and the bid-ask spreads tighten, I think there's a lot of pent-up reasons why companies and sponsors want to move forward on strategic decision-making. And so a lot of time has gone by. Now it's time to start moving forward again on things that you were thinking about, but maybe the environment is friendlier to do those things.
Got it. Okay, Devin. Well, that was all great. Appreciate all of your time here. Thanks a lot for joining us.
Yeah. Thank you, Joe.
That'll do it for this episode of the Pipeline Podcast. Thanks for listening.